Let's ask Tom Lee. He's Fundstrat's head of research, a CNBC contributor. Has been all over this move on the right side of it. Welcome back. It's good to have you. You know, what's interesting to me is you say that the risk reward in the market is still positive. I'm wondering, though, whether that spread is starting to narrow.
Hi, good afternoon, Scott. To us, stocks are rising for the right reasons. I know I've said that before because we've had good earnings, but also just evidence of really the scarcity of compute and the supply chain, whether it's semis and energy, and AMD's the latest example. But the market hasn't made these stocks expensive yet. The forward PE of the semi index is still only 22 times, and while that might sound high because they were expensive, more expensive than a month ago, they had gotten as high as 35 times over the last 20 years. So to me, there's still pretty good risk reward, even in the stocks that are leading this rally.
So the risk reward is still fairly balanced, I hear you suggesting. Is that right?
Yes, and I think that there's still, there was so much skepticism as the war started and reached its crescendo that we do believe there's still a lot of money on the sidelines. And, in this case, I think it's actually more retail investors that are chasing this move, and that may explain why we're seeing such big moves in things like memory and semis.
You don't think that, sentiment or what's being reflected in the market by virtue of some of these moves has gotten a little bit too much? I bring up this note today from Ed Yardeni, obviously friend of the show. He's on frequently, is talking about to infinity and beyond. What he's calling now the Buzz Lightyear theory, BLT, of AI. The data revolution is going to infinity and beyond. He says he's even more bullish than his original Roaring 2020s scenario. Is that well-founded? Is it a point of concern if you start getting some of the folks who are generally speaking pretty bullish to sound almost euphoric? Is that something to worry about?
I think it's something we have to calibrate because I'm actually here at the Milken conference, and I think one of the recurring themes is that AI for the U.S. is probably adding 2 percentage points to GDP each year for the next 5 years. So that's like 6% S&P earnings growth coming from AI productivity. And balancing that is, I know a lot of rational investors that continue to point to this coming shortage of petroleum products. So I think there's enough logical reasons for people to stay cautious, but I think there's now a fundamental argument for why AI is causing earnings growth without inflation. And so that is a good combination for stocks.
But see, I look at what you still suggest is a three-phase market. That's how you characterize it. A rise of the S&P to 7,300, check, right? We're there, beyond it. But then you talk about headwinds emerging. See, as we started this year, to refresh everybody's memory, you thought we were going to have a really good start to the year. We would drift into a bear market before another upswing would take us even higher into the end of the year. Now, when the war broke out and we had about 10% or so pullback in the S&P, I thought, well, maybe that's Tom's moment. He couldn't get the timing right, because who can? But that was the pullback, and now we're so bulled up on AI that maybe we're going to do just fine for the rest of the year. But you're still looking for a drawdown of 15 to 20%. Is that right?
I am, Scott. I think that 7,300 originally was like an aspirational level, and now that we're here, I think that there still is fuel for a move higher from here. But we do have to confront later this year two things, and maybe it won't affect the markets, but I think it's the trigger for a drawdown. One is, of course, the market will test a new Fed, and this incoming Fed chair has some different theories on the sources of inflation and how to read inflation, and so the market, I believe, will put those views to the test. And of course, the second is that every day that the strait is closed, we know that there's an acute shortage developing of petroleum products. So if price reacts later this year, that's going to test the market. So I do think there's the ingredients for turbulence later, but AI and the scarcity, and the U.S. is the provider of that scarcity, is why I think we can exit 77 or higher. And maybe 2027 is one of the biggest rallies we see in our lifetime. So I think it's still a bullish outlook, but turbulence in the middle.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
And describe in your words this change in strategy from never selling Bitcoin to managing the Bitcoin, what is it, price per share?
Bitcoin per share, yeah.
Okay, thank you. What is the philosophy behind this change?
Yeah, the biggest change that's happened to the company, and I would argue to Bitcoin and perhaps the financial markets in the last year, has been the advent of digital credit, which is Stretch. We've raised $8.5 billion in 10 months. And with that, we look at optionality, we look at our strategy, and we say, now, let's look at the Bitcoin and see if it can provide us value from time to time to sell it. And ultimately, I believe in math over ideology. And at the point where selling Bitcoin versus selling equity to pay a dividend is better for our Bitcoin per share and for our common shareholders, we'll do it.
So Stretch is a perpetual preferred stock with an 11.5% yield that's paid monthly. So is what you're saying that you're selling some of your Bitcoin holdings in order to pay this yield?
We will sell our Bitcoin to pay the yield where it's accretive to our shareholders, and that's defined as accretive to Bitcoin per share, right? And the times when it's accretive are when the book value of our company is trading, below the price, or the price is trading below the book value, right? Or MNAV is below right now 1.22.
So that's just for Stretch in particular?
That's just for Stretch, but we'll also look at selling Bitcoin, for example, to capture tax gains, right? Defer tax gains or tax losses in this particular case also.
What about strategy more broadly? You have $1.5 billion in terms of your outstanding dividend obligation, and you have about 18 months of dividend coverage. Is that right at current levels?
That's right. And then we also have behind that about $60 billion worth of Bitcoin to cover our dividends also.
Go ahead, Steve.
Talk about the concept of liquidity with me for a second. Liquidity, some people define as the idea that I can buy or sell an asset and not affect the price. That's not true for strategy, right? When you guys announce you're going to possibly sell Bitcoin, you're the largest corporate holder of Bitcoin, as I understand it. So do you feel like you have the liquidity for this, or the flexibility that you need for this strategy, or are you constrained by what happens when strategy sells Bitcoin?
Bitcoin trades north of $60 billion a day, right? And if our entire annual dividend is $1.5 billion that we have to pay, right, on a daily basis, we're talking percentage points or basis points of the Bitcoin liquidity. What you saw, for example, is the last couple of weeks, we didn't buy any Bitcoin, and Bitcoin price went up. So I don't think although we're a big player of overall Bitcoin, we own almost 4%. On a daily basis, I don't think we're driving the price up or down, and we're not a big part of liquidity isn't an issue for us.
And do you believe that there's any reason to question dividend coverage either for Stretch or for core strategy at this point?
Right now, our leverage is right around 10 to 15%. Our amplification is about 35%, right? And if you compare that to typical companies, we would be rated just based on those KPIs as an investment grade stock. So I don't see that being an issue right now, and we manage it very closely. We look at the equity, we look at the debt, and we try to manage our leverage and amplification level very thoughtfully.
Quick question that's been floated, this idea, would you hive off the software part of the business? Is that something you thought about?
Not really. The software business is a small, I would say, non-material part of our business, about $500 million in revenue, and grew 11% in the first quarter, so it's doing well. But it's neither a distraction nor an important asset in our overall business.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
First, let me start with some particulars. For the large cap Granny ETF, GRNY, the latest price was $26.70 and total assets of $4.4 billion. For the mid cap Granny J, ticker GRNJ, The price was $29.55 and total assets of $461 million. And for the income granny or granny I, the latest price was $29.55 and total assets of $461 million. Over the past week, the large cap granny gained 0.1%, while the S&P gained 0.92, so negative 80 basis points of underperformance. Granny J gained 2.3% compared to 96 basis points for the Russell 2500, or 133 basis points of outperformance. And Granny I gained 0.2% compared to a 0.9% for the Granny for the S&P, or 73 basis points of underperformance. Now, year to date, let's look at some numbers. Granny is up 7.83% compared to 6% for the S&P 500, or 181 basis points of outperformance. Granny J is up 16% compared to 13.8% for the Russell 2500, or 182 basis points of outperformance. And Income Granny is up 6.74% compared to 6% for the S&P 500, or 73 basis points of outperformance. So let's talk about macro. You know, if I had to say what's working in 2026, it's scarce assets are rising. In fact, it's something that I've been talking about multiple times, that stocks that are selling something scarce are outperforming. Compute, NVIDIA, Intel, AMD, for instance, AI hardware like Micron and SanDisk on memory, anything that sells energy infrastructure like GE Vernova, and services where supply and demand are greater like the Mag 7. By the way, this is really the basis for Granny Shots, so it's very consistent with what Granny Shots looks for. And you can see this on relative performance since the start of the war. It's everything that's pretty scarce in terms of tech, and then of course energy. But we are in the midst of fog of war, and you might be questioning whether or not stocks should go up. Well, oil prices do seem like they've peaked, and keep in mind, if oil is down, then you want to buy things with inverse correlation to oil. That's S&P 500, Ethereum, and the Mag 7. And as for earnings, it's been a great earnings season. 82% of the companies have reported, but 87% are beating. It's a huge number. And the magnitude of beat is 19%. I mean, that's what you expect to see out of an emerging market. This is out of the US. So it gets us to our base case for the year. As you know, we've been talking about a rise to 7,300, and we're there, but I don't think it's time to sell. But we think it's going to feel like a bear market later this year. We've already had what feels like a bear in the Mag 7 crypto and software. But the drivers there could be market testing the new Fed, or it could be a longer war. Don't know. But then I think we're going to have a rally that follows, takes us to at least 7,700. So I'm still bullish for markets. Now let's talk about individual Granny stock performance. The top 5 performers over the past week were Quanta, Google, Caterpillar, Tesla, and AMD. These were largely earnings beats. The underperformers were Vistra, GE Vernova, Meta, KLA Tencor, and Robinhood Markets, and some of these are earnings related. On Granny J, the top 5 performers were Bloom Energy, Sanmina, HF Sinclair, Carrier Global, and MP Materials. Mostly earnings here. But we've had some drags: AeroVironment, Domino's Pizza, Royal Gold, Elf Beauty, and SoFi Technologies. And you know what? SoFi had good numbers, but no guidance raise, I suppose. As far as themes, not a surprise. Global labor shortage and AI is number 1. Cyber and energy security, we've talked about that, is number 2. And season.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.